I'd like to ask you a little bit about Archegos, and I know that these are all situations that you all are kind of looking into, trying to figure out what happened with it. But with Archegos, it was leverage that was the serious problem. And the Federal Reserve, after the Great Depression, put all kinds of rules in place, put leverage rules in place that used to keep people at about 50%. You couldn't be levered at more than 50%. Of course, Wall Street since then has found all kinds of ways to kind of get around those rules. And one of those is total return swaps. That was the problem at Archegos. I know you can't comment specifically on Archegos, but what can you say about leverage and about finding ways to get much more leverage than the Federal Reserve ever intended? What are your thoughts?
Yeah, I think, Becky, you raised a really good question. I want to add something. I think it was about leverage and also transparency. So when one group, in this case, a purported family office, but one group wants to express itself in the markets through these derivatives called total return swaps and does it with multiple firms, then it starts to aggregate into significant positions. And we have a history in the markets to say if you have significant positions, there's transparency and the public gets to know if somebody's over 5% or sometimes it's over 10% of a company. And so that transparency was lacking here. And you're absolutely right also that through these derivative contracts in multiple banks, there was a lot of leverage in that trade, if I can call it that.
So is transparency the problem, or is finding ways around leverage the problem, or you think that those are both things that need to be cracked down on?
We're taking a close look at both. I asked staff to make recommendations to the full commission under existing authorities to bring more transparency to this derivatives market, but also to look more closely at these issues that you raise about leverage. Now, the SEC did have authority. It took a while, but did have authority to address these securities-based swap arrangements. This came out of the Dodd-Frank reforms, and that regime is going into place later this year and then into 2022. So I think there would be some more transparency, some more control on what's called margin, which is a part of this leverage calculation. Those rules have not yet gone into place, but I think we'll need more transparency than is even in those rules.
And one more question on this. It seems like some of the rules were flouted, too. Filings that were supposed to be made were never made by that family office. Are you going to be looking at enforcement for these family offices that are basically hedge funds that have tons of money and just don't seem to be following the rules that already exist?
Well, you can imagine I can't speak to a specific matter, but in general, we're going to examine and enforce the rules without fear or favor. We're going to look at individuals and corporations, and yes, that includes hedge funds, but of course I can't speak to any one individual matter.
Shepard Smith here. Thanks for watching CNBC on YouTube.